Felix here, war in Israel, horrendous images coming out of Israel, and the market isn't about to freak out. If you believe the headlines, it's all over. I want to take you through the actual facts and figures so you can be well informed, make better decisions, and make money. Yes, even in environments like this, everybody wants to make money, or at least not lose bucket loads of this stuff. First of all, we can make money in all situations, in all scenarios. We're up 112% return on capital employed this year so far. And I think everybody should know how that works. You deserve to know how this works. And therefore, we actually teach it for you, to you even, for free. I'm running a Sunday live trading training for all you guys with jobs out there who can't attend something during the week. Go to felixfranz.org/webinar. It's the coming Sunday at 10 a.m. and I'll teach you exactly how I trade, what I do. We'll do some trades together and I'll give you away my entire plan, the entire strategy. You have it. Now, it's horrible headlines like this that the Wall Street Journal put out. Iran helped plot attacks on Israel. This is what got the oil market freaking out. You'd think, right? Now, volatility, that's fear, that's the VIX, is up 9% pre-market. It doesn't look that big on this chart, but it's a monster gap up. That's pretty big. You've got headlines like this. Oil could spike well north of $150, which would be stagflation. Here we come on steroids. But let's look at the oil market. Historically, this was the 6th of October, 1973, Yom Kippur. And after that, there was an oil embargo basically on the Western world. And oil prices went from, I don't know, $6, $7 to like 50. And then Iran-Iraq war and so on, they went up to like 80. And that was a huge stagflation, inflation disaster. Are we going to get that right now? Well, have a look at how the oil markets reacted this morning. The oil market's been trading in this kind of path here, up by 25% since June. And then it broke down last week. Why? Because the algo funds bottled out and then the shorts had to cover their positions. So everybody suddenly had to revive the trade, or like rather undo their trade. So we are up pre-market 3%. Not exactly the calamity that the headlines are implying, right? So actually, no, there isn't at this point a massive threat to oil. Is oil going to go to $150? Nope. If they do, the United States would be self-sufficient, basically. US can pump oil out of the ground at relatively high cost, but at $150, they sure hell would do it. And the Saudis know it, OPEC knows it, everybody knows it, even Iran knows it. So yes, if this conflict escalates and draws Iran into it, if Israel strikes Iranian facilities, then the Gulf would be involved, and yes, oil prices would shoot up. But I doubt they'll go up to $150 because those people who've got oil, like the Saudis, would just pump a little harder. Now, you might think, well, isn't this good news because the Fed's going to bail us out? Well, see what Michelle Brown, voting president at the Fed, just said. She said, rates will probably need to rise further as they remain too high, and that elevated energy prices may reverse some of the progress. So if oil prices go higher, interest rates will go higher, which means you're going to get not a recession, but you're going to get a stagflationary recession, which is pretty much the worst case scenario. But the Fed, they don't seem to care. Bizarre, isn't it? Now, this little snapshot here is absolute gold dust, fresh off the Goldman Sachs trading floor, essentially, team. And it shows you what the big guys, the funds, have been trading last week. What are they buying? Well, they're buying mega cap techs and obesity drugs. That's essentially what they were buying. What are they selling? Renewables, non-profitable tech, and anything that's most shorted, which is, again, mostly non-profitable tech. And take some heed from that. That's the way it works. When people freak out, initially they buy big tech and they sell all the stuff that's non-profitable and more speculative. However, the bull market is still alive. October last year, we thought we were going to get the big recession slapping us in the face. And then 2 letters happened, AI. In March this year, bank failures, which is something that they're trying to whitewash from history, it seems, happened. And right now we're back here. So the line that's connecting these is still intact. So the bull market is still a thing. And it's surprising, but it's still a thing. Now, which sector should we be selling? Well, If you believe Goldman Sachs, oil, the student debt resumption, consumer credit, unemployment, and slower September consumption trends means sell retail. Sell the heck out of consumer stocks. And have a look at some of these. Pepsi, what happened here? Well, apparently the fat people on drugs no longer want to buy Pepsi. So Pepsi's had the worst day since 2008. Baffling, isn't it? Look at Coca-Cola. Same story. Again, it's about fat people in Walmart buying less Coca-Cola, allegedly. And then you've got the actual consumer staples ETF, which is called XLP, which is just committed suicide, basically. And that's an indicator of what to avoid. Or if you've got a really long time horizon, you love the contrarian thing, you could start nibbling and keep nibbling. And then in a couple of years, you be, Croesus, is that the king? Walmart, same story. Horrible Friday initially, but rebounded quite significantly, but still closing the day down. And that's again that's the fat problem, the fat drug problem, that apparently it makes people not want to buy junk, which is mostly what Walmart sells. Okay, let's move a little bit more bigger picture here before we look at what we can actually be buying and selling and trading. We've got a yield curve inversion that isn't news, right? Felix, I knew this a long time ago. Why are you telling me this? Because the yield curve inversion is when it goes down, but what has it just done? It's gone back up. I'm going to have to get a different color pen. Can't see the bloody thing. It's gone back up. When it goes back up, that's when you get the recession. That's usually when you get the recession. This was 2007. This was 2000. And you can go back in time and you've got, what was that, 90 or 89? It was 89 maybe. And then here you've got the glorious 70s. They had to wear flared trousers and beer drugs in the 70s because the economy was that bad. The uninversion brings poor returns. And look at the average numbers here. I think these come from Goldman's again. The 6 months afterwards, you made 3%. The 12 months afterwards, you made 4%. You're thinking, well, that's not terrible, is it? Yeah, but it's also not good, is it? When the US government pays you 5% risk-free, why the heck would anybody buy stocks when you get 4% historically after the yield curve is uninverted? Good question, isn't it? No one is buying calls. Nope, there are calls sitting in the corner feeling very sad for themselves because we're down here. Now, we've been lower. We were lower in COVID. We were lower in the 2018 financial crisis. We were lower in, let's draw a line across. It was 2011 and, 08. But still, it essentially is saying to you, no one's feeling really bullish. No one woke up this morning and went, I know what, Tesla to the moon. No, there are not that many of them left. You want some real world macro? Bankruptcy filings have surged to levels we haven't seen in COVID and 2008, the Great Recession, or rather the great big Ponzi scheme underwritten by ratings agencies. You got away completely scot-free. Lovely, isn't it? So that's an alarm bell. Then we have, of course, Friday. What the F happened on Friday? Well, on Friday, the government told us that they created 336,000 jobs in the economy, and that was double what we were expecting, and the world was a happier place. In fact, El Presidente came out and said, how are you? He said, he wasn't quite sure where he was at that point, and he said, since I've taken office, we've created 13.9 million new jobs, and I keep saying it, my dad had an expression, he said, Joey, a job is about a lot more than a paycheck. It's about your dignity, your respect, and honey, it's going to be okay. Well, 336,000 more Americans, if they had children, can say that to their children and mean it. The unemployed rate stayed below 4% for 20 months in a row, the longest stretch in 50 years. You might be thinking, isn't that glorious? Isn't that wonderful? No, it's a lie. Have a look at this. They seasonally adjust the jobs data. What actually happened is we lost 885,000 jobs, full-time jobs, in September. Yeah, we gained 1.1 million part-time jobs and 368,000 people who now work multiple jobs. Not usually a sign of everything is wonderful. You don't wake up in the morning and go, you know what? I love my job so much, I'm going to get another one. And then I'm going to get another one. And I'm going to work 24 hours a day because isn't the world a brilliant place and Joe Biden has fixed it for us? How about private sector? This is the private sector. Private sector lost 400,000 jobs in September. And Joe's government added 1 million jobs in September. Now, that's mostly teachers, which is a fair thing to hire in September, but it's not quite the same story, is it, that he's telling you? So that's why the market initially rallied and then looked a little deeper and went, whoops, right? What do you want to buy? Well, first of all, you don't have to make a decision. You could learn to be market neutral. I'm very happy to walk you through a trade, but really what I would say is the easiest thing. Go to felixfriends.org/webinar. Link is down below. There it is, even here, felixfriends.org/webinar. And just sign up and I'll teach you exactly how we do that. So what we do is we can be wrong on direction. I can think it's going to go up and it's going to go down and I still make money. I make half of all my money while I'm wrong. Lovely, isn't it? So if you don't want to trade 3 to 4 hours a week, which is what I do, then you could buy stocks with gross margins that are greater than 60%. This is my shopping list, my criteria. Return on invested capital, greater than 12%. Long-term earnings growth, not just last quarter, but the last couple of years, more than 12%. And you want free cash flow. What does free cash flow mean? Well, if you are growing and you're selling more, but you keep having to buy new inventory, build new factories, and scale, you never have any money in the kitty. And that's not what really the sort of business that I like. Now, you could just go and buy the SPY or the SPHQ. The Q stands for quality, which is more in line with what I've outlined up here. There are a bunch of other ETFs, of course, you could also look for. And that's a place to start to do some research, not financial advice, but I'm just giving you the criteria that I look at. Now, what about this whole war investing thing? It's of course not, doesn't make you feel particularly wonderful, does it? But look at this. The Vietnam War, markets dipped. Got a recession, recovered. The Gulf War, number one, markets dipped. We recovered. Afghanistan War, market dipped. Well, that was also something to do, obviously, with 9/11. And then recovered. And then Iraq, this is 2003. Market dipped. We recovered. The Crimean crisis, which is the official beginning of the Ukraine war. It's just that nobody really cared then, and now everybody seems to. Again, dip and then recovery. So you could argue, should buy the flip and dip, even if there is one, right? Now, what do you sell? Well, go through the above metrics that are lined out there and just go back in the video and take a screenshot. Sell the crappers and otherwise wait and hold. No one ever lost money holding the S&P for more than 20 years. Let me show you the data. Actually, I've got a chart. It's more pretty, isn't it? In a 10-year horizon, in bluer stocks, by the way, you made between -4 to 21%. But over a 20-year period, no one ever lost money, ever. So the answer to a lot of this is just, if you're patient, to wait a lot. And if you are impatient like me, you're really, really patient with your long-term investments, and then you trade in the meantime, because that way you have a sense of achievement and you can do a heck of a lot more, which is what we do. So I hope that's helpful to give you a framework of where we are at. So the headlines, the doom and gloom, don't get swayed by it. Don't panic, don't freak out, don't sell everything. Not financial advice, but that's what I would say to anybody that I care about. And then, of course, watch it, but don't watch all the depressing misery of the human nastiness that's going on there. It's just going to mess with your head and you won't be able to think clearly. And you need to think for yourself and your family and your own future. And then keep an eye on the headlines. If this does escalate to other countries, it becomes a bigger story. If it escalates to the Gulf, where the Saudis and the UAEs and the Iranians and the Iraqis and the Kuwaitis are, then it becomes a bigger issue for the stock market. At the moment, it's a human catastrophe, but it isn't an economic one beyond that particular spectrum. Now, if you're massively exposed to, I don't know, diamond cutters or something like that, that's really, really Israel-centric, it's going to impact you. But for most people, it probably won't impact them all that much. If you enjoyed the video, I appreciate you smashing the you know what, and I look forward to seeing you on Sunday on the live training.